Welcome to Thoughts on the Market. I am Vishy Tirupattur, Morgan Stanley's Chief Fixed Income Strategist. Today, we'll be talking about how private credit has evolved over 2024 and the outlook for 2025. I'm joined by my colleague Joyce Jiang from our Leverage Finance Strategy team. It's Tuesday, December 3rd at 10 a.m. in New York. A lot has happened over 2024 in private credit. We are credit people. Let's talk about defaults and returns. How has 2024 been thus far for private credit in terms of defaults and returns?
It's always tricky to talk about defaults in private credit because the reported measures tend to vary a lot depending on how defaults are defined and calculated. Using S&P's credit estimate defaults as a proxy for the overall private credit defaults, we see that defaults appear to have peaked, and the peak level was significantly lower than during the COVID cycle. Since then, defaults have declined and converged to levels seen in public loans. In this cycle, the elevated policy rates have clearly weighed on the credit fundamentals, but direct lenders and sponsors have worked proactively to help companies extending maturities and converting debt into PIK loans. Also, the high level of dry powder enabled both private credit and PE funds to provide liquidity support, keeping default rates relatively contained. From a returns perspective, for credit investors, the appeal of private credit comes from the potential for higher and more stable returns, and also its role as a portfolio diversifier. Data from Lincoln International shows that over the past 7 years, direct lending loans have outperformed single B public loans in total return terms by approximately 2.3 percentage points annually, largely driven by the better carry profile. And this year, although the spread premium has narrowed, private credit continues to generate higher returns. So, Vishy, credit spreads are close to historical tights, and the market conditions have clearly improved compared to last year. With that, the competition between the public and private credit has intensified. How do you see this dynamic playing out between these two markets?
The competition between public and private credit has indeed intensified, especially as the broadly syndicated market reopened with some vigor this year. While the public market has regained some share it lost to private credit, I think it is important to note that the activity has been, especially refinancing activity, has been really more two-way. Improved market conditions have lured some of the borrowers back to the public markets from private credit markets due to cheaper funding cost. At the same time, borrowers with lower rating or complex capital structure seem to continue to favor private credit markets. So there is really a lot of give and take between the two markets. Also, traditionally, private credit markets have played a major role in financing LBOs or leveraged buyouts. Its importance has really grown during the last Fed's hiking cycle when elevated policy rates and bouts of market turmoil weakened banks' risk appetite and tightened public funding access to many leveraged borrowers. Then, as the Fed's policy tightening ended and uncertainty about the future direction of policy rates began to fade, deal activity rebounded in both markets and more materially in public markets. This really led to a decline in the share of LBOs financed by private credit. Of course, the two markets tend to cater for deals of different sizes. Private credit is playing a bigger role in smaller size deals, and a broadly syndicated loan market is relatively much more active in larger sized LBOs. So overall, public credit is both a complement and a competitor to private credit markets.
The decline in spread basis is evident in larger companies, but more recently, the spread bases have even compressed within smaller sized deals, although they don't have the access to public credit. This is likely due to some private credit funds shifting their focuses to deals down in the size spectrum, so the growing competition got spilled over to the lower middle market segment as well. In addition to pricing convergence, we've also seen a gradual erosion in covenant quality in private credit deals. Some data sources noted that covenant packages have increasingly favored borrowers, a reflection of the heightened competition between these two markets. So, Vishy, looking ahead, how do you see this competition between public and private credit evolving in 2025? And what implications might this have for returns?
The competition, I think, will persist in next year. We have seen strong demand from hold-to-maturity investors such as insurance companies and pension funds. And this demand, we think, will continue to sustain. So the appetite for private credit from these investors would be there. On the supply side, the deal volume has been light over the last couple of years. Next year, acquisition LBO activity likely to pick up more materially given the solid macro backdrop, lower rates that we expect, and sponsor pressure to return capital to investors. So in 2025, we could see greater specialization in terms of deal financing. Instead of competing directly for deals, public and private credit markets can find their own niches. For example, public credit might dominate larger deals, while private credit could further strengthen its competitive advantage within smaller size deals or with companies that value its unique advantages, such as the flexible terms and speed of execution. Regarding returns, while spread premium in private credit has indeed come down, a pickup in deal activity could to some extent be a release valve. But sustained competition may keep the spreads tight. Overall, private credit should continue to offer attractive returns, although with tighter margins compared to historical levels. Joyce, it was great speaking with you on today's podcast.
Thank you, Vishy, for having me.
Thank you all for listening. If you enjoyed today's podcast, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.